If you have questions, concerns, and are just lost when it comes to planning for retirement, meet Steve Hoyle and Derek Caldwell of the Hoyle Financial Group. The clock is ticking on the so-called Trump tax cuts. They are due to expire at the end of next year. And if you want to take advantage of lower tax rates now, you can do what's called a Roth conversion. That's where the money goes in after tax. But then you have Ed Slott. He's a tax guru. He recently told Morningstar that many are skeptical because then they think that the government's going to do some backpedaling and then try to tax Roths next. Listen to this.
I'm going to give you the secret that Congress doesn't want anybody to know. Don't worry about it. Congress loves Roth IRAs. I mean, loves, addicted, that kind of love. It brings in money. It helps pay for everything else. So luckily for us, they're so short-sighted. Remember, the only money that can get in a Roth is already taxed money. So they look at the Roth IRA as a revenue source. So I don't think they're going to kill their golden goose.
Interesting here. So he says they're addicted to these things and the golden goose here. So I guess really the question is, guys, do you agree? And how much of our retirement nest egg should we have converted to a Roth before these Trump tax cuts end in potentially 2026?
As much as you can afford to. You know, a lot of people will come see Derek and myself and they'll say, oh my gosh, I don't want to do that because all my income will be taxed at that higher rate. Absolutely not. We have a graduated tax system. You know, each level you pay to that level, then you go up to the next tax bracket. So I'm just telling people taxes may go up if the Trump tax package is not renewed, 15, 20, 22% more. I mean, it could be huge. And I'm telling you, what an opportunity to take control of your taxes. Get them out of the way. Just think about retiring and having tax-free income. It could keep you from having to pay the Medicare tax. It could keep you from having taxes on your Social Security. It could really make a pivotal difference, especially with the inflation we're experiencing in this country. Don't you agree, Derek?
Well, absolutely. And what we try to do a lot of times for everybody listening is to structure those in a way that makes sense, because it's not something where if you have $500,000 in an IRA, in most cases, you never want to do a Roth conversion on all of that, right? I mean, because that is a major taxation that you're paying up front, and it takes a considerable amount of time to earn that back and make it tax efficient there. But structuring that out over the next couple of years, yes, now's the time to do that and to take advantage of that. And if we can keep you from paying any more taxes than you would do normally on your income, that's where we're going to keep you. And we'll give you kind of options on, hey, I think you should do $35,000 this year and $40,000 next year and $35,000 after that. It's a process, and one thing we hear a lot of times is that, well, I don't want to take it out. I don't want to pay the taxes, which is understandable. None of us want to pay taxes on it, but the government's good at what they do, guys. They're going to get your money eventually. When you pass away, what you're doing is forcing your kids to then pay a higher tax burden in most cases. And even if you're passed away, do you want your kids to pay more taxes to the government than you could right now? No way. Like, do something about it and be proactive and get with us, because we structure those out all the time for people and make sure that's tax efficient and it's going to grow for you. Because like Steve said, tax-free income, guys, after 5 years, I mean, there's no other gift like that right now that's available to us tax strategy wise. And it's a gift right now. I don't know if they will go after it. I could say in the future, probably so. That's going to be something they look at. So now's the time to do it. Get that in a Roth and everything and set up structures where, hey, 3-4 years from now, if they want to come after it, hey, you got most of your money already converted over. Do what you need to do kind of thing. So
I agree with that Slot. It's all of a sudden getting taxes up front, and the government needs that upfront tax money. I mean, look at the national debt. It's crazy. So, I just think that there's no time like now to take control of your money. It's just huge. When you think about taxes, when you think about retirement, think about paying less money in retirement and taxes, call us. Let's do a Roth analysis or do an entire tax analysis and see what taxes look like in your retirement.
We've been talking about Social Security for, I feel, weeks now at this point. Lots of rumors swirling around. Where will it be in the next possibly 10 years? Some speculate that it'll be cut back 25% in the year 2035. And, of course, no one wants to deal with it right now. Everyone's looking the other way. Well, I've recently came across an article that says waiting until 2035 is the same as trying to change the course of the Titanic after hitting the iceberg. We all know how that turned out. Didn't turn out great. So the whole point is that if Social Security goes away completely or it's diminished, are there things we can do now to better prepare ourselves?
Yeah, I mean, you want to be able to replace that income. That's the first thing we generally look at is how it'll affect your income in retirement, because that is one of the very few dependable income sources that people have in retirement. Otherwise they have to lean on their retirement assets. And in most cases, if you're not properly diversified, you're yanking money out of the market. And you're doing that every month to supplement income. Well, Social Security drops off even by 30% or so. What do? Right? You ratchet up your withdrawals. And maybe your portfolio can handle it. Maybe it can't. But that's one of the things we do too, and analyze that for you. Because if it does happen, we want you to be prepared and have a plan and a course of action that you are comfortable with and you know exactly what's going to happen, because it could cause a ton of problems, even for people that have retirement assets, because maybe your portfolio cannot handle that additional amount of funds coming out of it. Maybe we're in a recession at that point. I mean, there's a lot of things that could happen, and we're not here to, debate on Social Security in most cases, right, Steve? We think eventually there will be a change of some sort. What it looks like, we don't know. But what we can do right now is to prepare our clients, and anybody listening, you need to be prepared if that happens, because I am in my 40s, and I guarantee you that I'm already telling my wife and friends, Social Security may or may not be there, but it won't look like it does now. You cannot depend on it. Don't depend on it. Get your portfolio where it's shock-proof, where if that happens, you're okay.
Yeah, I think it's so important when you think about the finances and future and retirement, Derek, to take control of the things that you can control. People come to see me and say, I'm so worried about Social Security, I'm going to take it at 62. Well, if you do that, you're leaving 8% a year on the table all the way to age 70. Is it good, bad, or ugly? I think that's ugly. I just don't think that's a way to fix it. Where else can you go and get a guaranteed 8% roll-up each and every year, Derek? It's huge. Guaranteed by the government. But what's interesting is, Derek, Social Security was never meant to be a retirement strategy. It was an addition. It was a plus strategy. And I think people need to think of it that way. Think about the whole pizza or the whole wheel, and each slice is something different. But what's important too, Derek, is so many people say, well, I have to take Social Security at 62. Absolutely not. You know what you can do? Come to us. Let us sit down and show you what bucket of money to use at the right time to fill that gap. It's so important. But, knowledge is power, and doing nothing is just not an option at this point.
A stock market bubble happens when share prices increase rapidly beyond the value of companies. Financial author Harry Dent tells Fox Business that we've been experiencing a run-up that might burst pretty soon.
This bubble's been going 14 years instead of most bubbles 5 to 6. It's been stretched higher longer, so you'd have to expect a bigger crash than we got in 2008 to 9. This thing has got to blow. It's showing signs of topping here, but we've got to see a crash of about 40%. I can tell you there has not been one bubble, and this is far larger and longer, one major bubble in history that has not ended badly, period.
Wow. Okay. So lots of, lots to unpack there. Are you seeing the same thing as Harry right now, guys?
NVIDIA is really concerning to me. It reeks of the dot-com bubble burst. Their growth is exponential. Their numbers look very good as far as, profit, earnings per share, a lot of stuff there, but they have grown so big, so fast. In fact, just the other day, they eclipsed briefly Microsoft for, market capitalization there. And we're at, briefly once again, but the biggest company in the United States. So, yeah, that's concerning when you see that kind of growth so fast. I believe it's over 4,000% in the last 3 years as far as growth. And the AI push that we see on the markets and everything, it's a hope for the future and AI technology and a lot of those things, but it's not a lot of practical usage right now for that. Technology still has a long way to go. And so people are funneling money into, not just NVIDIA, but I'm just using them as an example there. But the dot-com bubble burst was, if everybody remembers that back in 1999, 2000s, it was horrendous on the markets. And with NVIDIA being that big, if it drops, the market, it can't support it. The market as a whole will drop considerably because of that kind of company and how big they are. So I definitely see that there's going to be a pullback. I definitely think the tech sector, I will go and say it's a bubble waiting to burst, the tech sector. I don't know how big it's going to be, but, we're going to see a pretty huge drawback, and I think that will probably occur in the next year.
So let me ask you this, for the average folks out there, yes, let's flash back to 1999, 2000, the tech bubble, and 2008. And then, of course, we've heard a lot of other professionals out there saying that 2024 could be the year of the worst recession, right? Bubbles are going to be popping. What's going to happen with your money and in the market, your 401k, et cetera? For us normal folks out there, all we understand, and we, myself included, is if I hear a report that says the Dow's up, the Dow's down, and I'm hoping everything's okay. But how do you implement a protection plan with my investments within my retirement plan?
I think the first thing we have the Hoyle solution. And when we put people in our portfolios and everything, it is a very consistent manner in what we protect your funds. We are going to use fixed index annuities to protect your funds. They're a fantastic way for great upside potential growth while minimizing any, if at all, fees. We keep fees minimum there too, but also we want to provide you with a portion of your portfolio within that, and we utilize that for safe haven for some of your assets. And we do that because diversification is the first thing we look at. You need bank assets. You need money in fixed index annuity. You need money in the market. All those play together because not only does it provide you options for withdrawing, it provides you with growth options where if the market does tank on you, you can still have considerable growth going forward and you can recover. And we do it that way because like fixed index annuities, the market goes down, you still have what you put in there and you can ride back up the high and let your market assets recover. There's a reason we diversify in these three large buckets, and we go into more detail on each one of them, but that's as a whole, that's how we provide safety, liquidity, and growth.
But Derek, I also think that what's important, like you say, you need to have money in the market. But the problem that I see is people come see us and they have 98% of their money at risk.
Yeah,
they don't realize it. If you look at the rule of 100, and it says basically take your age from 100, and if you're a high risk person, that's the most you should have in the market. Say you're age 60 and take it away from 100. That's 40% is the most. We see people have 97% money in the market. And I think, Derek, what it really boils down to is no one wants an equity indexed annuity, but they want all the features of it. There's some great ones out there. And, during 2022, the S&P fell, 19.85? Let's just call it 20%. Zero would have been your hero if you're one of our S&P allocations in a fixed indexed annuity. Wow. The next year you had great gains, but you didn't lose a penny. I think that's the opportunity for a part of your money.
Yeah, Steve, I agree 100%. It's about options. It's about creating the three things I spoke about. Those are the Hoyle solutions, what we call them, is the liquidity, the growth, the safety. That's what you need in portfolio because you're right, Steve. You can't have 98% of your funds in a 401k, guys. You can't. I mean, you will get trashed if the market goes down. So be proactive. Give us a call. You can go to our website, retiredtexasstyle.com. Even a quick 15-minute meeting. You know, if you have a couple questions, you can get in touch with us, with me or Steve. Just right in the middle of the page there, Retired Texas Style. You can click on the link. You can give us a call. That is what we do on a daily basis, is the whole solution, is making sure that you retire Texas style.
CNBC looked at how many years $1 million in retirement savings would last in various states. Turns out, and location is pretty important, guys. If you retire with that much money at age 60 in California, New York, and Hawaii, you're going to run out of money by the time you're 75. On the other hand, it'll last closer to 25 years if you are more in those southeastern states. So bottom line, can you design a retirement plan that takes location just out of the equation?
Yeah, absolutely. You know, that's something, factoring cost of living, inflation, all those things we do. We can stress test your portfolio if you decide, hey, Derek, I'm thinking about moving to California to be closer to my kids. Hey, absolutely, because those are a lot of factors you have to take into account. You know, California has a state income tax. Texas doesn't. So gasoline is a lot more expensive there. That those kind of things occur on a daily basis. And even rental property or Airbnbs are real popular right now. Where you purchase those, your vacation homes, things like that. There's a lot that goes into it. And it's something that a lot of people are like, hey, I'm just going to do that because it's what I want to do. Yeah, you want to move closer to your family. I get that. But let's take a look at this, because we're going to have to adjust our rate of withdrawal in a lot of cases. Or, you know, if you're going from California to Texas, for instance, maybe you have more flexibility. We can go higher growth. We can take out less money if we need to. But all that stuff factors in. And honestly, guys, I can't believe $1 million, 15 years in California. But you know, when people come in and talk about income and everything, if you have $1 million and it lasts 15 years, you know, if you retire 65, guys, I mean, the odds are you're going to be retired for 20 years, you know, with Social Security and your retirement income. So that is a long time, obviously, right? $1 million, 15 years in California. So there needs to be a plan in place. I mean, I can't harp on that enough, Steve, right?
Absolutely. It's funny. In Dallas, Texas, I think it's a little bit of California now. We have so many people here from California. And, you know, when you saw Toyota move in here and all these companies, we talk about immigration. Well, Dallas has it. And, you know, Amarillo, if you look at the ratings, and Lubbock is as well, you know, one of the top cities to retire in. We have so many people moving there that are my age. I used to say retired people. Well, they're my age. I'm 61. They're moving in like groves. And, you know, it's interesting. And you think about Santa Fe through to Mexico. There are so many people moving here. And, you know, it's a great place to live. It's a great lifestyle. But, you know, it's not as expensive. You know, Derek, one of the things I think about expenses, we're talking about money, is I think about what toll tax cost in Dallas. It's incredible. I mean, it's just incredible. I mean, in Amarillo, Texas, you don't need an engine because the wind will blow you where you need to go, for one. And two, it's free to drive on the highways. I'm just having fun with you.
No, there's a lot of that, like you mentioned, Steve, little taxes and little differences when you wherever you live. You know, a big thing, guys, is healthcare costs. They vary tremendously, not just from state, but from city to city, too. So Dallas healthcare costs are about 25% higher than the Panhandle area. So, yeah, it's a lot different depending on where you live. So those are factors that we can show you. So we use averages in not just a state level, but a local level to increase and show inflation on long-term care, healthcare costs, all those things we factor in, because we stress test your portfolio over and over and over again, and we will continue to do so to make sure that you are in a good place and give you choices in what you want to do.
Absolutely, Derek. And, you know, we talk so much about numbers and money, but also that's 25% of the equation. I like to talk also about the other 75%. It's the emotions. It's what retirement looks like. What do you want to do in retirement? That affects the money so much. All those things do. But when we talk about getting together, we're going to look at all of that and put together, because at the end of the day, we have to know the other part for Derek and I to really understand the numbers so you can retire well and do everything you want to do in retirement. It all starts with a phone call or go to our website, retiredtexasstyle.com. But if you really want to experience the Hoyle difference, give us a call. We'll make that happen. Let's sit down, have a visit. Let's have a 15-minute Zoom or phone call, and let's make sure that your goals are aligned with what we think we can do for you. You know, for the past 35 years, we've been partnering with people just like you to experience the Hoyle difference, and we can't wait to talk to you.
If you'd like to sit down with Steve and Derek or a member of the Hoyle Financial Group, visit retiretexasstyle.com.
Investment advice offered through Hoyle Wealth Management, a Texas-registered investment advisor able to provide investment advice in states where it's registered, exempt, or excluded from registration. Content contained herein should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of loss, including possible loss of principal. Please consult with a qualified financial, tax, accounting, or legal professional before implementing any ideas or strategies discussed here. Content provided is obtained from sources believed to be reliable but cannot be guaranteed as to its accuracy or completeness. By contacting us, you may be provided with information about insurance products, including annuities offered through Steve Hoyle, Texas Insurance License 716036. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company. Read your contract for restrictions, limitations, or penalties. Steve Hoyle is not licensed in all 50 states. To find out if Steve Hoyle is licensed in your state, please call 806-371-9473.